Welcome in. Today we're going to talk about what we spent our last newsletter on and our most recent article, and that is why you should 4X your starting retirement balance. And so let's talk specifics real quick. Let's say you enter retirement with 4 million or 10 million or 1 million, whatever the number is. You need to 4X, and historically that's a very low estimate. Even 5, 6, 7X is pretty reasonable over the last century. You need to at least 4X your starting retirement balance to understand your lifetime income and your legacy assets that you would pass on to family, friends, charity, or the IRS. So why is this an important topic? It has huge implications for how you invest. It has big implications for your retirement income plan. And certainly it amplifies the tax issue. So if you're trying to minimize the amount of tax you pay within your retirement assets, it's really helpful to understand that your starting balance in retirement is just a fraction of what you're likely going to deal with over the course of your lifetime. Now, let's set the stage. I use this example, and I think it's really helpful. Small decisions, when they're extrapolated over a long period of time, they become enormous decisions. So I use the example of driving in Houston, and let's say that you're in Houston, you're in the heart of Houston, you're wanting to go to Florida. So you're heading to Florida, pretty simple operation. You're going to take I-10 East. Now, what if you take a wrong turn? What if you hit 45 north instead of I-10 east? Well, in that case, 5 or 10 minutes later, it's just not a big deal at all, right? Yes, you made a wrong turn, but 10 minutes later, you can simply get on 610, head east on 610, and that's going to take you right to I-10. You're going to get to Florida, all is good. 5 or 10 minutes later, a wrong decision is not a big deal. But when you start to introduce a longer period of time, all of a sudden you're in a completely different universe. And financially, this is absolutely the case. Back to the Houston to Florida analogy. 4 hours later, it's a big deal. You're north of Dallas, and you should be in Louisiana. 8 hours later, you're thinking you might actually be in Florida, and instead you would be in Wichita. So huge difference when you make a decision, and it ends up being the wrong decision when you extrapolate your decisions out over a long period of time. Why am I talking about this as it pertains to retirement planning? Well, let's just say that you're going to retire at age 60. That's a pretty standard age. We see anywhere from 55 to 65 when we think about oil and gas retirees. So let's just hit on age 60. Well, at that age, you should assume that there's a reasonable chance that you or your spouse, if you're married, you should assume that you might live to 95. So you think about financial decisions and the consequences they carry. It's not just the consequences that a decision carries, 6 months from now or 1 year from now. No, your decisions will be ones that financially you have to live with 30 years from now, 35 years from now. So we're going to talk about a few different things, and I want to pull up some quick notes. I want to talk about 4 things. So there's some mental pitfalls with this topic that are really important to avoid, but really there's 3 topics I want to hit on. So understanding this dynamic, understanding that 5 million can really carry $20 million of consequences. Well, that influences your investment decisions, your retirement income decisions, and your tax consequences. So investments, retirement income, and tax, let's talk about all of them. Now, I mentioned there's some mental pitfalls to avoid. So let's touch on that real quick. Whenever you hear that your starting balance might 4X, it sounds ridiculous. How in the world, let's say you're 60 and you have about 5 million in assets, how in the world is 5 million going to just magically turn into 20 million? And I would suggest that is an extremely low estimate. The human brain, this has been well documented and well researched, really an interesting kind of field of study. I think Morgan Housel has some amazing stuff on this. The human brain is not wired to understand compound interest at all. We just don't get it. And so the idea that 5 million could turn into 20 million just sounds loony. It sounds like, well, you must have put everything in one single stock at an IPO and it must have just turned out perfect. But that's just not the case at all. Historically, 4xing your starting retirement balance would be a really low estimate. So when I say 4x, what I'm talking about is your starting retirement balance that should produce lifetime income plus a legacy balance that passes on to family, friends, or charitable organizations or the IRS. Those two things should add up to 4 times your starting retirement balance. And again, that's a really low estimate. So if you hit age 60, you have $5 million, you want to retire, understanding that there could be 35 million worth of investment decisions to make, or $35 million of consequences, $35 million of retirement income throughout the rest of your life, plus your legacy balance, that absolutely could happen. So first things first, let's talk about compound interest. 5 million, if it's simply invested in a diversified portfolio, and let's say it makes 7% per year, over 35 years, it's going to be $53 million. And so that is just a little primer, but as we know, that's not a reasonable, that's really not relevant when it comes to retirement planning, because you have 2 factors at play. One, you're wanting to spend this money. That's the purpose of retirement. You're not continuing to invest it unfettered for several decades. No, you're taking active distributions. You're living off of this money. But 2, we also have taxes that will rear their head. So no, you don't get to simply compound your money endlessly without any friction. Even if you weren't taking distributions to pay for living expenses, even if you had some sort of pension on top of these assets that covered all of your expenses, taxes will still erode some of this return. At age 72, you have required minimum distributions. You have to take taxable income from your pre-tax retirement plans, and that taxable income, the amount of annual income you take, will influence your Medicare surtaxes. So you have a lot of different dynamics at play. But I think the big thing to say here is I would challenge you to begin to understand that, yes, compound interest absolutely ensures that this dynamic is real. You are going to 4x and you might 7 or 8x your starting retirement balance, especially if you live more than 3 decades. Now, let's talk a little bit about the investment consequences of understanding this. So again, what are we hitting on? Let's draw out and picture a retirement timeline. So when you're making investment decisions, yes, and apologies for my line there, but yes, you are making them now at age 60, but these decisions are going to be extrapolated decades into the future. So when you're making investment decisions, critical to think through 2 different things. And the first one pertains to market timing. You have to have an ironclad conviction that you will not do this. You cannot time the market. Right now, we're in the middle of the crisis in Europe, so Ukraine and Russia, certainly that's had a big impact on what's going on. It's had a big impact on the markets. But I just want to throw this out there. Situations like this are going to happen, and historically they have happened all throughout rolling 30-year time periods, 35-year time periods. So when you think about retirement lasting potentially 30, 35 years, important to really map that out and understand that. Let's pull up some different helpful markers here. So first and foremost, capital markets have rewarded long-term investors. Making investment decisions is a really big deal, because when you zoom in, it may not be a big deal. Again, back to the driving analogy. If you're trying to head to Florida, I-10 East is going to get you there. But if you accidentally go on 45 North, 5 minutes later, it just doesn't matter. You're really not hurt at all. You've maybe added 10 minutes to your trip. Just head on 610, you're good to go. So if we zoom in, investment decisions aren't a big deal. Compare government bonds, treasury bills, inflation. And this graph visually just doesn't even do it justice because, again, for the first 5 years, first 10 years, first 12, 15, 20 years, it's not a big difference. But when we zoom out, there is a just cataclysmic difference between investing in equities versus being a lender, investing in bonds, investing in cash, or what are traditionally known as safe assets. So no, you cannot time the market. You have to be a long-term investor. And what I really want to point out here, the reason why it's such a big deal, this is super helpful. This is a 30-year period we're looking at. So this is the S&P 500. And what if you missed just one day? No, you cannot time the market. If you miss one single day, you took away thousands of dollars. You took away incredible capital over a long period of time. But what if you just missed 5 days? In that case, your return was almost cut in half if you missed the 5 best days in the market. Missing the 15 single best days in the market, 25 best days in the market, absolutely erodes your return. And you are sitting with a return similar to T-bills. So back over here, T-bills compared to large caps, compared to small caps. Simply put, it is absolutely necessary if you're looking at a multi-decade retirement, you must own equities. You have to have an ownership stake in the greatest companies in the world. The stock market is not a nebulous casino. It is an avenue where you can have an ownership share in the greatest companies in the world. And so again, 1, don't time the market. 2, you must have equity exposure. You must own stocks. Now, certainly you need to have a thoughtfully diversified portfolio. Absolutely recommend that you get a CFP's opinion on it. And we've written a lot on that topic. So there's a lot of ways where you can go wrong as an equity investor, but it is critical to your long-term success that you make investment decisions to ensure that over decades you are owning the great companies of the world. You're not a lender investing in bonds and cash. Now, let's go back to the main points we want to cover. So that hits investment consequences, retirement income. What we want to hit on here is, and let's map this out real quick. So this is, we'll just pinpoint this one. So this is 5 million in assets starting at age 60. On the left is a 5% withdrawal with a 3% inflation increase. On the right is a 4% withdrawal with an inflation increase. So this is coming from the 4% rule. So if you've heard of the 4% rule, pretty famous just in retirement income planning. You can reasonably take 4% of your starting asset balance and then every year increase it by 3% rate of inflation. And as you can see, that 3% will compound over the years. But retirement income wise, when you think about zooming out in the impact of your starting balance, over 35 years, a 5% starting withdrawal rate, if you started with 5 million, it means that your lifetime income will be over $15 million. And you might look at this and say, not every expense in life goes along with inflation. So let's get specific. Your last 10 years of life, you may not be actually spending over $500,000, $600,000, $700,000 a year. That might be absurd. And I would agree with that. Not every expense in life is subject to inflation. But again, your lifetime assets, that's lifetime income plus your legacy balance, it really doesn't matter. In fact, if you spend less, it really is just going to increase the principal balance, the legacy balance that you pass along to family, friends, charities, or the IRS. And so that kind of helps frame the picture. But when you think about retirement income decisions, you really need to get these first several years right. If you're spending too little, well, you're going to get to age 85. You may not have the freedom health-wise to do the things that you could do in your 60s, and you're going to regret having this balance at 18, 19 million, and you simply didn't spend as much as you could have. You might regret that. If you have family vacations that you want to take, if you have things you want to do with kids, grandkids, friends, if you have charities you want to support, I would very much challenge you to think about that now. And something we try to do with our clients on an annual basis is nudge them if they're spending too little. It's okay to do that, and I think that's a worthy cause to build a legacy balance, to give it to family, friends, or charity. I think that's a fantastic thing to do, to keep spending in check and build that legacy balance. But if there's things you can do with your family, I mean, absolutely. We want our clients to know that hey, you can spend more than you're currently spending. Because again, if you get that nudge in year 5, year 4 of retirement, there's time to make a change. Or let's talk about the opposite problem. What if you're spending too much? You go down to these later years. Yes, because of portfolio growth, it would be reasonable 25 years down the road for you to be able to live off of a substantially higher income from your portfolio. But what if you start out taking $600,000 a year from a $5 million portfolio? Well, if we have a rough next 5 or 10 years in the market, yeah, you might wake up in year 10 and it might be too late to make a change. Because again, decisions made in the first few years of retirement, those are going to have big consequences when you then fast forward decades into the future. So retirement income wise, you want to avoid those two pitfalls. You don't want to spend too little. You also don't want to spend too much. Now, last point, taxes. This is a big deal. Let's map this out. I mentioned NUA and Roth conversions. So you think about an IRA, and for a lot of the clients we work with, when you retire from a large oil and gas company, let's say you do have $5 million, it would be normal for most of that to be in a pre-tax IRA, split between a 401k and a pension. Now the difficulty there is your IRA balance is going to be subject to taxes. And really, again, whatever your starting balance is, map this out and understand what makes sense from a tax perspective. So what we try to do is not necessarily maximize a single year's tax efficiency. Instead, we want to zoom out. We want to ask the question, what is your optimal lifetime tax rate? And that's a big deal because back to this timeline, I keep mentioning this idea that decisions at age 60 have a big consequence. But I want to draw something in the middle here, and that is age 72. And the reason I draw 72 is you really can't do a whole lot of tax planning once you hit 72. You're taking Social Security, so Social Security is going to largely dwarf, it's going to consume the lowest tax brackets. So NUA, Roth conversions, those get really exciting when you have low tax brackets to utilize them in. Especially Roth conversions, extremely powerful at the 0% tax bracket, 10%, 12% tax bracket. Roth conversions at a 30, 32, 35% tax bracket are not as compelling. So when you think about the potential of getting $500,000, $1 million from your IRA into your Roth IRA over the course of a 5 or 10 year period, doing partial Roth conversions, that can have a 7-figure impact. Because yes, let's say that over a 5 or 7, 8 year period, you get $1 million out of your IRA and you get that into your Roth IRA. Well, that $1 million, again, yes, it is there when you do it, but 30 years later, as your money continues to compound, this is a really, really big deal. So if your money just continues to compound inside of an IRA and it is subject to required minimum distributions, and there's significant restrictions if you have children, when they inherit this account, they have to take it out in 10 years on top of their other income. Making a $1 million Roth conversion over a 5-year period that can have 7-figure consequences in lowering your lifetime taxes based on your children's future income situation, based on your R&Ds, or simply if one spouse passes away before the other one, and now that surviving spouse is taxed as a single taxpayer. And this is potentially in your 80s or 90s when the R&D percentage is not 4%. No, it might be 6, 7, 8% later in life. And so these have huge consequences. So in other words, you have the ability to make some tax decisions. Again, let's draw this line. You have the ability to make some of those tax decisions in your first few years of retirement, but they have to be done early, and they really need to be done while you have non-retirement assets. That's how it's best organized. In many cases, it can make sense to spend your brokerage assets, your checking savings account first, your non-retirement assets first, and fund Roth conversions at the lowest tax brackets during those years. And doing that can have enormous ramifications. So I think we've spent plenty of time on this topic, but big picture, interesting thing to think about when you have a asset balance of whatever it might be, whether it's 500,000 or 50 million. It's really helpful to understand that your lifetime income, your legacy balance is going to be substantially higher than that. When you introduce the potential for living 30, 35 years. So critical to think through these things: investment, retirement income, tax implications. And we look forward to doing more of these.